Okay, so you want to own a repossession company. You buy a self-loading tow truck. A bank sends you a vehicle identification number and an address. Your driver finds the car, lifts two wheels, moves it to a secure yard, uploads photographs, and sends an invoice. The lender has the contract. The borrower missed the payments. You have the truck. It sounds almost mechanical. It is not. The lender does not pay you because your driver visited an address. It pays because the correct collateral came back under control, without unnecessary damage, without a violent confrontation, without violating a legal protection, and without the assignment being canceled 30 seconds before the hook touched the car. The lender pays for the recovery. Your company pays for every address that produces nothing. Your expenses begin before the truck leaves the yard. Your revenue may never begin at all. In September 2022, the Consumer Financial Protection Bureau found that only 27% of accounts assigned to repossession in its dataset were completed. 3 years earlier, the figure had been 38%. That means the assignment queue can look full while most of it never becomes a paid recovery. The address is stale. The vehicle moved. The borrower voluntarily returns it somewhere else. The lender pauses the order. A bankruptcy or military protection changes the legal position. The car sits behind a closed garage. The borrower objects and the driver has to leave. Or another agent reaches the vehicle first. At the same time, the market is enormous. Outstanding American auto loan balances exceeded $1.64 trillion through the third quarter of 2024, spread across more than 100 million active accounts. Cox Automotive estimated that approximately 1.73 million vehicles were repossessed during 2024, the highest annual figure since 2009. Those numbers make repossession look like a booming volume business. From the owner's desk, it looks different. Every lender wants faster recoveries. Every borrower interaction can become a complaint. Every truck costs money while moving and while parked. Every assignment contains personal information. And every successful recovery becomes your responsibility before it becomes the lender's recovered asset. By the end of this video, you will know which version of the company you could actually own, how much equipment and working capital it may require, where the fee really comes from, why most jobs disappear before completion, how the middlemen took control of the assignment stream, and what a realistic regional operator might earn when the recovery rate moves by only a few percentage points. Because you are not just buying a towing company, you are buying the field operation that turns a digital default file into documented physical custody. Before buying a truck, you need to decide which business you are entering. The first is the owner-driver recovery company. This is the smallest version. You own one self-loader, work a defined territory, and receive assignments from local lenders, credit unions, dealerships, or national forwarding companies. You may operate at night, handle your own updates, and use a partner yard or a small secure lot. The visible investment is the truck. Current dealer listings show how wide that number can become. A used self-loader with substantial mileage has recently been listed around $85,000. A new 2026 heavy-duty chassis fitted with a Jerdan self-loading unit has been advertised above $220,000. The cheap truck creates repair risk. The expensive truck creates debt service, and neither one creates assignments. The second business is the regional recovery agency. The owner-driver owns the truck. The forwarder owns the queue. This company owns several self-loaders, perhaps a rollback carrier, a secure storage yard, cameras, lighting, dispatch software, and enough staff to cover several counties. It can accept more difficult vehicles, handle more volume, separate field work from office compliance, and build direct contracts with larger lenders. This is the model people imagine when they hear Repo company. It is also the model we will stress test later. The third business is the forwarding company. The forwarder may own no hook trucks at all. It receives thousands of past due accounts from national lenders, selects local agents, monitors performance, centralizes updates, and gives the lender one vendor relationship instead of hundreds. The local agent owns the truck and performs the recovery. The forwarder owns the queue. That distinction has reshaped the industry. Among completed repossessions in the CFPB dataset, the share involving a forwarding company rose from approximately 31% in early 2018 to 66% by December 2022. The lender gains a nationwide dashboard. The forwarder gains the assignment relationship and the performance data. The local recovery company gains volume, but may give up pricing power and direct access to the client. These are not three sizes of the same operation. The owner-driver sells local field capacity. The regional agency sells field capacity, custody, and compliance. The forwarder sells coordination, data, and vendor control. An owner can begin with one self-loader. But a one-truck operation is mostly a demanding job you created for yourself. To test whether it can become a scalable company, our financial model begins at the next stage: 4 field routes supported by 4 self-loaders and 1 rollback carrier in Florida. Florida is useful because the ownership barrier is visible. The state separately licenses recovery agencies, individual agents, interns, branch offices, and agency managers. A company engaged in the business needs a Class R agency license for each location, and a manager needs qualifying recovery experience. So you cannot simply buy the truck on Friday and legally start taking cars on Monday. The equipment is only one gate. Experience, licensing, and client approval are the others. The truck lets you perform the work. It does not make anyone send you the work. The bank is not hiring you because it wants a car moved 6 miles. A normal towing company can move a car. The lender is hiring you because a loan has stopped behaving as expected, and the collateral may no longer remain where the paperwork says it is. The lender wants 4 things. The first is speed. A vehicle can move across town, cross a state line, be damaged, stripped, hidden, abandoned, or continue losing value. The CFPB found that average time from assignment to completed repossession ranged from approximately 16 to 23 days across borrower credit tiers in its 2022 data. Every additional day is another day the lender does not control the asset. The second is certainty. The vehicle identification number has to match. The lien and assignment have to be valid. The photographs, condition report, keys, and location record have to show exactly what was recovered and when. The truck performs the visible act. The process around it is what the lender buys. The third is restraint. The lender has a contractual right to recover collateral after default, subject to state and federal law. That right does not give your driver permission to use force, enter a closed garage, or turn an objection into a confrontation. A profitable agent knows how to recover a car. A durable company knows when not to recover it. The fourth is an audit trail. The lender needs to know when the order was accepted, when the address was checked, when the vehicle was located, whether a cancellation arrived, when the car came under control, where it was stored, and what personal property was inside. That is why the modern repo company is partly a field operation and partly a data operation. Recovery Database Network says its systems connect more than 600 national lenders with more than 2,500 service providers. Its lender tools emphasize automated compliance rules, service-level agreements, performance comparisons, and complete activity trails. Those are vendor claims, not independent market statistics. But they reveal what the buyer values. The lender is not choosing the company with the strongest-looking truck. It is choosing the vendor most likely to return the correct car quickly and produce a record that survives a complaint, regulator, lawsuit, or internal audit. This changes how you should think about the fee. A 2026 procurement benchmark places a standard vehicle repossession service around $419 per vehicle. Actual contract prices vary by client, market, vehicle, difficulty, forwarding arrangement, and approved additional services. $400 sounds expensive for a short tow. It sounds much smaller when it has to pay for the unsuccessful addresses, dispatch staff, insurance, storage security, software, photographs, personal property handling, and the legal decision to leave when the recovery cannot proceed peacefully. The truck performs the visible act. The process around it is what the lender is buying. Open your dispatch screen on Monday morning. There are 600 active assignments. That number feels like business. It is not revenue. It is inventory with an uncertain conversion rate. Suppose your 5-truck fleet receives 7,200 assignments during a year. At a 32% completion rate, you recover 2,304 vehicles. At a 23% completion rate, you recover 1,656. Same client list, same trucks, same yard, same number of accounts flowing through the screen. The difference is 648 completed jobs. At $500 of average retained revenue per completed case, that difference approaches $325,000 before considering the effect on storage, transport, and other approved services. 600 assignments can look like demand, while most never become revenue. This is why assignment volume can be one of the most misleading metrics in the company. A low-quality portfolio can overwhelm your drivers with addresses and still produce less cash than a smaller, cleaner lender relationship. Every unsuccessful attempt has a cost. The driver receives wages. The truck uses diesel. Tires, brakes, and hydraulics wear. Software continues billing. The yard remains staffed. The dispatcher records the result and schedules the next action. In many contracts, the meaningful recovery fee arrives only after the vehicle is secured. Some clients may pay approved attempt, transport, or special service charges, but you cannot build the company on the assumption that every visit becomes billable. The completion rate is not entirely under your control. Lenders decide when to assign the account. The address in the file may no longer match the vehicle's actual location. Forwarders decide which agent receives the work. A payment can post while your driver is approaching the vehicle, and the servicer's cancellation message can arrive late. The CFPB has repeatedly identified wrongful repossessions caused by communication failures after a consumer made a payment, entered a deferment, received an extension, or otherwise took action that should have stopped the repossession. For you, cancellation speed is not a customer service detail. It is a control system. The assignment must be live when the recovery begins, and a canceled order has to reach the field immediately. A company that updates the driver every hour is not compliant enough if the cancellation arrives 1 minute after the last refresh. That is why modern lender systems use mobile updates, status locks, and confirmation records. The owner sees a screen full of opportunities. The good operator sees a screen full of jobs that can disappear at any moment and builds the workflow around that fact. Now, let us build the regional company. This is an original illustrative model, not an industry average, dealer quote, or lending offer. You want 4 self-loading trucks because the company needs enough field capacity to cover several territories and enough redundancy that one hydraulic failure does not stop the entire operation. 2 are newer units budgeted at $210,000 each. 2 are used units budgeted at $90,000 each. Add 1 used rollback carrier at $120,000 for vehicles that should not be moved on a standard wheel lift, for longer transport, and for overflow work. Modeled fleet investment, $720,000. The equipment explains why experienced operators do not view a repo truck as a normal pickup with an attachment. Jerdan's current light-duty integrated units list an underlift capacity of 4,000 pounds and a winch capacity of 8,000. A carrier adds a full deck and different loading capability. Each configuration solves a different problem. The correct fleet size is not what you can finance. It is what proven volume can keep productive. Each one also has its own financing, maintenance, inspection, tire, and downtime profile. Next comes the yard. You need fencing, controlled gates, cameras, lighting, an office, secure key storage, personal property storage, a release area, and enough space to move vehicles without creating damage claims. Assume $180,000 for deposits, leasehold work, surveillance, access control, and early rent. Add $90,000 for dispatch computers, mobile devices, software, data services, document storage, radios, office equipment, and initial technology setup. Add $110,000 for licensing, legal work, training, background checks, insurance deposits, client onboarding, and professional setup. Then, add the part that makes the company survivable. Working capital. The trucks have payments before the lender pays your invoices. Employees need payroll while you are still being tested by forwarding companies. One major client can take weeks to approve the first batch. A damaged truck can create a repair bill while its assigned territory produces no recoveries. Set aside $250,000. Total modeled startup requirement, $1,350,000. Assume you invest 40%, $540,000, and finance the remaining $810,000 over 7 years at 8.5%. Modeled annual debt service is approximately $154,000. That is the bill before the first profitable year. The trap is obvious. You can buy too little equipment and lose assignments because you cannot cover the territory. Or you can buy too much equipment and spend every month chasing enough recoveries to feed the debt. The correct fleet size is not the number of trucks you can finance. It is the number your proven completion volume can keep productive. The popular image of repossession begins when the truck reaches the car. Your profit begins much earlier. A lender may provide the contractual address, vehicle description, VIN, account status, and other authorized information. The address can be current. It can also be months behind the borrower's actual life. The owner who treats every assignment as one drive to one driveway builds an expensive sightseeing company. The stronger operator treats the assignment as a probability problem. A 2026 New Yorker profile of veteran recovery agent Matthew Pittman described how he built an edge by reopening old, unfulfilled assignments that other operators had stopped working. The useful lesson is not any particular tactic. It is that a stale file can still contain value when one operator notices a lawful connection that others missed. Which accounts have reliable, recent information? Which locations can be checked efficiently inside the same route? Which vehicles require specialized equipment? Which assignments have legal holds, bankruptcies, military flags, or new payment activity? Which clients require a particular update before another field attempt? The field agent is not supposed to improvise outside the law. The company uses authorized client information, compliant data tools, public observations, and documented procedures. It does not need cinematic tricks. It needs a precise VIN, current assignment status, lawful location information, and disciplined reporting. You do not win by driving everywhere. You win by placing limited time where completion is most likely. License plate recognition networks have become part of this process. The CFPB defines an LPR network as a third-party service that compiles vehicle location information from cameras or devices collecting license plate images. Used correctly, a location hit can prevent hours of low-probability driving. Used carelessly, sensitive location data creates privacy, security, and compliance risk. That is why software access, user permissions, encryption, and audit logs matter. The repo company is holding addresses, account status, vehicle identifiers, photographs, and movement data connected to real people. A stolen truck is expensive. A stolen database can threaten every client relationship at once. Route density matters just as much as technology. Imagine two companies recovering the same number of cars. Company A completes 3 jobs inside one metropolitan area with short moves to a nearby yard. Company B completes 3 jobs scattered across 200 miles. The invoice count is the same. The fuel, driver hours, wear, and next-day capacity are not. That makes territory design a hidden margin lever. A national lender may offer more assignments than you can intelligently service. Accepting every county can increase the dashboard volume while reducing profit per truck. The owner has to know the difference between market coverage and unproductive distance. The search business is not won by driving everywhere. It is won by placing limited field time where a lawful, completed recovery is most likely. Now your driver finds the vehicle. This is where the business can change in seconds. In many states, a lender may repossess a vehicle after default without first filing a lawsuit or giving advance warning, depending on the contract and state law. But the recovery cannot create a breach of the peace. The exact definition depends on state law and court decisions. The Federal Trade Commission gives common examples: using or threatening force, or removing a vehicle from a closed garage without permission. For the driver, the operating principle is simpler. When peaceful recovery stops being possible, the recovery stops. That can mean leaving a visible vehicle. It can mean losing the fee. It can mean another trip later or the lender choosing legal process. And it can still be the most profitable decision your employee makes all month. The car may be worth $20,000. Your invoice may be $400. No rational owner trades a confrontation, injury, lawsuit, and client termination for one recovery fee. The physical danger is not theoretical. A 2026 New Yorker investigation reported that at least 7 repossession workers were killed in 2023, described as the highest number on record. Sometimes leaving the car is the most profitable decision your driver makes all month. That figure comes from journalistic reporting rather than a federal occupational data set, so it should be presented with attribution. But the business lesson does not depend on the exact count. Your employee is approaching an emotionally loaded asset that many Americans need to reach work, school, and medical care. The borrower may have no idea the lender sent the assignment. The agent may have no idea who is inside the home. Training cannot eliminate that uncertainty. It can create a default response: disengage, document, and leave. There is another legal check the borrower may never mention. The Service Members Civil Relief Act can require a court order before repossessing a vehicle financed before qualifying military service when the protected service member made a payment before service. In February 2026, the U.S. Department of Justice announced that CarMax would pay nearly $500,000 to remedy unlawful repossessions involving protected service members. The lender carries the central duty to validate the order. Your company still needs a process that respects client holds and court order requirements, rather than treating every assignment as identical. The owner cannot turn the field agent into a lawyer. The owner can build a system where questionable status stops the job instead of rewarding speed at any cost. That is the paradox of the industry. You are paid for recovering cars quickly. You remain in business by knowing exactly when speed becomes liability. The car is on the truck. You are not finished. You have just taken custody of a complicated container. There may be tools, documents, medication, child seats, electronics, work equipment, clothing, identification, and other personal property inside. Those items are not automatically the lender's collateral just because they were left in the vehicle. State rules and client contracts govern notice, inventory, storage, and return. The CFPB has repeatedly criticized practices where consumers were required to pay a fee before receiving personal property from a repossessed vehicle. In a 2020 settlement, Nissan Motor Acceptance Corporation agreed to pay a $4 million civil penalty and was required to prohibit repossession agents from demanding personal property fees as a condition of returning belongings. That case involved the lender's practices and service provider conduct. For the recovery company owner, the lesson is direct. Personal property is not a side drawer of the business. It is a separate custody obligation. Your staff photographs and inventories items according to the contract and applicable law. Property has to remain identifiable, secure, and retrievable. The company needs a release process that does not confuse a borrower's belongings with the lender's vehicle. The car itself creates another record. Condition photographs protect against claims that your driver caused damage. Mileage, keys, visible defects, and equipment have to be documented. The yard needs controlled access because a stolen or vandalized recovered vehicle is now a problem inside your custody. Then comes state notifications. The recovery ends for the driver. Custody begins for the company. Florida law, for example, requires notice to the police or sheriff in the jurisdiction where property was recovered within 2 hours after recovery. That is not a ceremonial filing. Without accurate notification, the borrower can report a stolen car and trigger a law enforcement response to an otherwise lawful repossession. Storage looks like ancillary revenue from a distance. From the yard, it is land, insurance, cameras, staffing, releases, paperwork, and exposure to damage. The lender may authorize daily storage, transport, key service, or other charges under its contract. The consumer may see those amounts later as repossession-related fees. The CFPB found that consumer-charged repossession fees in its 2022 data averaged roughly $500, and accounts routed through forwarders showed higher average charges than accounts without them. That amount is not the local agent's clean revenue. Some lenders use flat consumer fees. Some invoices include forwarding, towing, storage, or other services. The lender, forwarder, and local agent may each touch the economics. The consumer sees one line on a statement. The owner sees several companies, several rules, and a vehicle occupying space every day. Handling that vehicle correctly protects the fee you already earned. It does not guarantee that another assignment will arrive. To keep the trucks working tomorrow, you still have to win and keep the client. A lender or forwarder does not award meaningful volume because your truck looks new. It wants evidence. Licenses, insurance, background checks, training, secure facilities, data controls, complaint procedures, and documented processes for cancellations, personal property, vehicle damage, military protections, and bankruptcy holds. Industry associations sell certification and compliance training because clients need a standard way to evaluate thousands of small providers. The American Recovery Association includes certified collateral recovery specialist training in its membership and argues that forwarders, direct agents, and other providers should face comparable insurance and certification standards. That is an industry position, not a law. But it reveals how the market sells trust. Compliance becomes part of your sales pitch. Once work begins, the promise becomes a scorecard. A client may measure acceptance speed, percentage of accounts recovered, days to completion, update quality, voluntary surrender coordination, damage claims, complaints, and cancellation response. The dangerous owner chases recovery rate alone. The durable owner asks what produced it. Did drivers ignore disputes? Did the company accept territory it could not service efficiently? Did a high recovery rate come with more damage claims or complaints? The lender wants the vehicle back. It does not want a method that creates more legal and regulatory cost than the collateral is worth. That is why hiring matters more than the truck specification. A driver can learn the controls. Judgment is harder. The employee must verify identifiers, follow the live status, document condition, and leave when the situation becomes unsafe or legally uncertain. Compensation can distort that judgment. Pay only for completed recoveries, and the driver may feel punished for disengaging. Pay only by the hour, and productivity can weaken. The owner needs an incentive system where a correct cancellation and a safe withdrawal are not treated as failures. That is loss prevention. One wrongful recovery can create towing expense, replacement transportation, lost wages, property claims, legal fees, regulator attention, and client termination. The fee from 100 correct jobs may not cover the damage. The contract is won by promising performance. Compliance is not paperwork after the job. It is part of the product you sell. It is kept by proving that performance does not depend on reckless decisions. But even after you qualify, the assignment may not come directly from the bank. To understand who controls your volume, follow the order one step upstream. Many national lenders use forwarding companies. The forwarder accepts a portfolio from the lender, distributes assignments to local recovery agencies, monitors updates, standardizes invoices, and evaluates performance. The arrangement solves a real problem. A national lender does not want separate software, contracts, insurance checks, complaints, and audits for hundreds of small agencies. It wants one accountable interface. The forwarder becomes that interface. The CFPB's forwarder analysis is narrower than a market-wide assignment statistic. It covers completed repossessions in its lender dataset. Within that group, forwarder involvement rose from roughly 31% in early 2018 to 66% by December 2022. Comment-charged repossession fees were also higher in completed cases involving forwarders, about $618 on average in 2022, compared with roughly $511 without one. That does not prove the forwarder kept the difference. Portfolios, services, and fee structures may differ, and some lenders charge flat consumer fees unrelated to the exact vendor invoice. But it shows that another economic layer exists. From your desk, the forwarder offers volume and geographic reach. It also creates dependence. The platform can see your acceptance speed, recovery rate, days to completion, update quality, complaints, damage claims, and coverage gaps. It can move future assignments to another agency without selling a truck or closing a yard. That performance data becomes a moat. The local operator may think the fleet is the asset. The forwarder may believe the vendor network and ranking system are the asset. You now face a strategic choice. Remain a subcontracted field provider and optimize for density, low overhead, and excellent scorecards. Or build direct lender relationships, cybersecurity, insurance, audit capacity, and compliance staff to capture more of the client value yourself. Direct work can protect pricing and the relationship. It also forces your regional company to carry more of the coordination burden that the forwarder previously absorbed. There is no free margin. The best regional operators use forwarders for volume, without allowing one dashboard to become the entire company. Because when one platform controls most of your assignments, it also controls whether your trucks stay busy. The forwarder can reassign your volume without selling a truck or closing a yard. And that is the bridge to scale. The next truck matters less than the quality and diversity of the assignment flow feeding it. Adding trucks is the most visible way to grow. It is not always the smartest. A fifth truck increases coverage. It also adds debt, insurance, maintenance, a driver, and the need for more assignments. The more scalable assets are less obvious. The first is route density. 10 additional assignments inside an existing territory can be more valuable than 50 assignments scattered across a new state. The second is the lender relationship. A direct contract with predictable assignment quality and clear pricing can be more valuable than a larger stream of low-probability forwarder accounts. The third is the operating record. Every accurate update, clean condition report, and correctly handled cancellation strengthens the scorecard that determines future volume. The fourth is the yard and transport network. A well-located, secure facility can support several trucks, voluntary surrenders, short-term storage, and efficient movement to auctions or lender destinations. But storage only scales until land, staffing, and release work become the bottleneck. The fifth is software and discipline data. A company that can see which territories, clients, and account types generate profitable recoveries can stop confusing activity with margin. The owner should know contribution by lender, not only total revenue. How many assignments did the client send? How many were completed? How many miles and field hours were consumed? How often did the client cancel late? How long did it take to approve transport? How many days did vehicles occupy the yard? How many invoices were disputed? The sixth is specialization. Commercial equipment, motorcycles, recreational vehicles, boats, and heavy assets may require different licensing, equipment, and expertise. Higher fees do not automatically mean higher margins. A specialized company wins only when it has enough repeat volume to justify the capability. The final scalable layer is forwarding. A regional agency can eventually coordinate work beyond its own territory through vetted partners. At that point, it begins becoming the middleman it once complained about. The economics change. You need fewer additional trucks per new state. You need more vendor management, insurance verification, cybersecurity, audit capacity, and complaint resolution. The field risk moves to the local partner. The client risk remains with you. That is why the largest-looking company is not necessarily the one with the most tow trucks. It may be the one with the most trusted place in the assignment chain. The truck captures the collateral. The network captures the margin. Now let us calculate how the illustrative 5-truck regional fleet behaves. These are original stress tests, not reported company results, industry averages, lender promises, or investment projections. The modeled company requires $1,350,000 to open. You invest $540,000 in equity and finance $810,000 over 7 years at 8.5%. Annual debt service is approximately $154,000. The agency receives 7,200 assignments during the year, 600 per month across several clients and territories. The fee assumptions separate local company revenue from the larger amount a lender may ultimately charge a consumer. Your completion rate reaches 32%. You complete 2,304 recoveries. The average retained base recovery fee is $425. List depot, transport, voluntary arrangements, key services, and other ancillary work add an illustrative portfolio average of $155 per completed case. Total average retained revenue per completion, $580. Modeled annual revenue, approximately $1,336,000. Operating cash costs total approximately $1,065,000. Payroll and benefits, $460,000. Fuel, tires, maintenance and repair, $180,000. Yard, utilities and security, $115,000. Insurance, $125,000. Software, data, licensing, training, compliance, legal and administration, $105,000. Subcontracted transport, key work, and case-specific outside services, $80,000. Modeled operating cash profit before debt service and tax, approximately $271,000. After approximately $154,000 of debt service, the modeled pre-tax cash result is about $117,000. On $540,000 of modeled equity, that is roughly a 22% pre-tax cash return. That is the base case, not a promise. Keep the same 7,200 assignments and the same $580 of retained revenue per completed case. Now, reduce only the completion rate from 32% to 23%. You complete 1,656 recoveries. Modeled revenue falls to approximately $960,000. Some variable costs decline because there are fewer completed moves and fewer case-specific services. Assume operating cash costs fall from $1,065,000 to $930,000. Operating cash profit before debt service is only about $30,000. After debt service, the modeled pre-tax cash loss is approximately $124,000. The queue stayed full. The conversion did not. Now restore the 32% completion rate and 2,304 completed recoveries. This time, hold volume constant and change only the revenue mix. More work arrives through lower price channels. The retained base fee falls to $400 and ancillary retained revenue falls to $90 per completed case. A full assignment screen does not pay you. Completion and retained pricing do. Total retained revenue per completion drops from $580 to $490. Modeled annual revenue becomes approximately $1,129,000. Keep operating cash costs at the base case level to isolate the pricing effect. Operating cash profit before debt service falls to approximately $64,000. After debt service, the modeled pre-tax cash loss is approximately $90,000. This is the central lesson. A full assignment screen does not pay you. Kompertiakonski compliant recoveries restore physical control to the lender, and only the fees retained from those recoveries pay your company. Completion risk can break the model. Pricing risk can break it too. The owner has to measure them separately. A repossession company looks like a truck business because the truck is the object everyone sees. The borrower sees the truck. The neighbor sees the truck. The camera sees the truck. The lender sees something else. A digital default file that became documented physical custody of the lender's collateral. To create that outcome, your company has to do much more than lift a car. It has to receive the correct assignment, verify that the order remains active, find the correct vehicle lawfully, stop when peaceful recovery is no longer possible, protect military, bankruptcy, and other legal holds. Document condition. Note the required authorities. Secure personal property. Store the vehicle. Update the lender. Move the asset toward sale. And preserve enough evidence to explain every step months later. The physical tow may take minutes. The business exists in everything around those minutes. That is why the strongest operator is not necessarily the most aggressive. It is the company that converts the right assignments without turning the wrong ones into disasters. The owner who watches only truck count will overexpand. The owner who watches only assignment volume will confuse activity with revenue. The owner who watches only recovery rate may reward the exact behavior that destroys the client. Relationship. The numbers that matter are more connected. Completion rate. Days to recovery. Miles per completion. Revenue retained per case. Cancellation speed. The truck is the tool. Judgment is the moat. Damage and complaint rate. Client concentration. Yard days. and the percentage of decisions where the driver correctly chose to leave. If those numbers work, the company can grow from one truck to a regional fleet, from a regional fleet to direct lender contracts, and perhaps from direct contracts into a forwarding network. If they do not, more assignments simply create more places to lose money. So, if you decide to open a repossession company, remember what you are actually selling. Not force, not a tow, not the humiliation of taking somebody's car. You are selling a lender the lawful, documented recovery of physical control over defaulted collateral. The truck is the tool, the assignment is the opportunity, judgment is the moat, and the field link in the credit system is profitable only when it knows exactly which cars not to take.